right now, millions of Americans are basically pouring their hard-earned money into permanent life insurance policies. And, they're mathematically programmed to eat themselves alive before you even pass away. I mean, people are treating these policies like impenetrable steel vaults, right? Just assuming that, well, as long as I pay my premium, that shiny death benefit is
Yeah,
guaranteed. Yeah.
absolutely. But beneath the surface, there's actually a hidden mechanism actively working against them.
Yeah.
It's a systemic issue.
Yeah.
And it all comes down to a single, really highly technical metric that's buried so deep in the fine print that most policyholders, and frankly a lot of agents too, just fundamentally misunderstand how it dictates the whole survival of the policy.
Right, which is wild. So today, we're taking a deep dive into the internal mechanics of life insurance to expose that metric. We are bypassing the glossy marketing brochures and, going straight into the actuarial realities. And our sources for this deep dive are the internal technical files of the Groen Insurance Group. So we have their actual case studies, their mathematical modeling for policy structuring, and the consumer toolkits they use to audit failing policies.
Yeah, and the material from Grewing is incredibly revealing because it doesn't treat life insurance as a static product. It treats it as a living, breathing financial ecosystem where the underlying risk is just constantly shifting between the insurance company and you, the consumer.
So our mission today is to pull back the curtain on a concept called the net amount at risk, or NAR. We're going to unpack how insurance companies calculate their actual real-time bets against your life.
Because if you don't understand how your NAR moves over time, I mean, you literally cannot know if your policy is building wealth or just quietly bleeding out.
Okay, let's unpack this. We need to start by defining what this metric actually represents because, when I buy a $500,000 policy, my assumption is that the insurance company is taking on $500,000 of risk.
Right, right. And that assumption is the most common misunderstanding in the entire industry.
Wait, really? It's not true.
It's only true on day one, and honestly, only under very specific circumstances. So to grasp how life insurance actually operates, we have to look at the formula for net amount at risk. And the calculation is, it's surprisingly elegant.
Okay, what is it?
It's just net amount at risk equals your total death benefit minus your accumulated cash value. That is the true measure of the insurance company's financial exposure at any given moment.
Oh, wow. So if I've built up cash value inside my permanent life policy, the insurance company is essentially offsetting their own risk with my money.
Exactly.
So, if I have a $1 million death benefit and I've accumulated $200,000 in cash value, the insurer is not actually on the hook for $1 million if I get hit by a bus tomorrow.
Not at all.
They're only risking $800,000 of their own capital because, well, the other $200,000 was already sitting in my account.
You're hitting on the core mechanism there. The cash value basically acts as a buffer. From an actuarial standpoint, the insurance company looks at your policy every single month, assesses that cash value, and calculates the difference.
Right.
And they only charge you for the pure mortality risk on that remaining difference. That is your net amount at risk.
So think of it this way. Imagine you have a jar. You put $80 of your own money in it. If an insurer promises to cover any missing amount up to $500, they only have to cover $420 if you die. The $80 was already yours.
That is a perfect analogy, yes.
Okay, but so what does this all mean for my monthly bill? Where does the rubber meet the road?
Well, if we connect this to the bigger picture, let's talk about the internal charges. The source is referred to the cost of insurance, or COI.
And just to be clear, this is not the premium I pay every month, right?
No. This is the internal fee the insurer deducts from your cash value to keep the death benefit active. And that cost of insurance is calculated as a specific rate per $1,000 of your net amount at risk.
Okay.
So mortality tables dictate the rate based on your age, gender, your health classification. As you get older, the probability of you passing away obviously increases, which means the rate per thousand naturally goes up.
Right.
The insurer takes that age-based rate and they multiply it by your net amount at risk to determine your monthly internal deduction.
Yeah.
A higher NER means higher monthly deductions for pure mortality risk.
Wait. If the rate per thousand goes up every year because I'm getting older and my cost of insurance is constantly being deducted, how on earth do level premiums work? If my risk is increasing exponentially as I age, shouldn't my premium just skyrocket every year to keep pace?
Well, that brings us to the underlying genius of how traditional permanent policies were originally designed. To really understand it, we need to look at how different policy structures handle that net amount at risk over time.
Let's start with the baseline, term life insurance.
Term life is the straightforward one.
Exactly.
There's no cash value component at all. You just pay a premium, you get a death benefit for, say, 10 or 20 years, and if you outlive it, the contract ends.
And because there's zero cash value to act as a buffer, the net amount at risk in a term policy remains at 100% of the death benefit for the entire duration of the contract.
Right, that makes sense.
Yeah, if you hold a $500,000 term policy, the insurer carries $500,000 of pure risk from day 1 to year 20. The math is just completely transparent.
Which explains why term insurance is relatively cheap when you're 30, but exorbitantly expensive if you try to buy it when you're 70.
Because the insurer has no cash value to offset that massive mortality risk at an older age, but traditional whole life operates completely differently, right? With whole life, I'm forced to overpay in the early years so that a portion of my premium builds that cash value buffer.
Right, and the dynamic shifting of risk in a whole life policy is exactly what allows the premium to stay flat.
Oh, I see.
Yeah, in the early years of a whole life contract, you're young and your mortality rate is low, but your net amount at risk is high because you haven't built much cash value yet.
Right, right.
But as the decades pass, two distinct curves begin to cross. Your age-based mortality rate curves upward exponentially. But because a portion of your level premium is constantly funding the cash value, your net amount at risk is curving downward.
Oh, wow. Okay, the insurance company is applying a much higher risk rate, but they're applying it to a significantly smaller pool of money. So, if my IRA drops from 500,000 down to 100,000 by the time I'm 70, the insurer doesn't care that my mortality rate is 5 times higher because their actual financial exposure is a fifth of what it used to be. The two forces just neutralize each other.
Precisely.
Yeah.
The internal math is basically engineered to balance itself. In fact, traditional whole life contracts are designed so that the cash value mathematically equals the total death benefit by the time the policyholder reaches actuarial maturity.
Which is usually age 100 or 121, right?
Right. And by that point, the net amount at risk is exactly zero.
That is a fascinating way to look at it. You are basically self-insuring over the course of your life and just using the insurance company's framework to house the funds.
Yeah, exactly.
But that system only works perfectly because a whole life policy is rigid, the premium is fixed, the contract forces you to build that cash value so the NAR drops on a predictable schedule.
That's right.
So what happens when we strip away that rigidity? Because looking at the Gruen files, they spend a massive amount of time warning about flexible premium policies.
Yeah, the flexibility you're referring to is the defining feature of universal life, and more specifically today, indexed universal life, or IULs. These products were created to give consumers options.
Okay.
Unlike whole life, where the premium is mandatory, an IUL lets you pay more, pay less, or even skip premium payments entirely, as long as there's enough cash value inside the policy to cover those internal cost of insurance charges.
I mean, on the surface, that sounds like a fantastic consumer benefit, right? If I lose my job or I have a tight financial year, I don't lose my insurance. I just let the cash value cover the internal costs for a while.
It sounds great.
But based on the actuarial warnings in these files, that flexibility is a double-edged sword that shifts the entire burden of managing the net amount at risk directly onto you, the policyholder.
The shift in burden is profound because you're no longer forced to fund the cash value on a rigid schedule. You introduce the very real possibility of underfunding the policy.
Right.
And if you pay a minimum premium, your cash value grows anemically. But meanwhile, you are still aging. Your mortality rate per thousand is still climbing.
And here's where it gets really interesting and honestly a little terrifying. The Gruen files describe this mechanical failure called a lapse spiral.
Or the death spiral. Yeah.
Death spiral, right. If I'm holding an IUL and I haven't been funding it aggressively, my cash value is low, my NAR is high. As I hit my 60s and 70s, my age-based cost of insurance spikes. How does the spiral actually initiate?
So the trigger point happens when the monthly cost of insurance charges surpass the interest being credited to your cash value. Once those internal fees exceed the growth of the policy, the insurance company has to start deducting the difference directly from your principal cash value.
So the buffer starts shrinking.
The buffer shrinks. And if we go back to our formula, death benefit minus cash value equals net amount at risk. What happens when the cash value decreases?
The net amount at risk goes up, the gap widens, the insurer is suddenly exposed to more risk than they were the month before.
Exactly. The math creates a vicious feedback loop. The cash value drops, which forces the NAR up. A higher NAR means the internal cost of insurance is applied to a larger dollar amount, resulting in an even higher monthly deduction.
Wow.
And then that larger deduction drains the cash value even faster the following month, which pushes the NAR up again. The policy essentially cannibalizes itself at an accelerating rate.
And the craziest part is the policyholder might not even realize this is happening because they're still paying their normal, flexible premium every month. They think they're covered, but internally the engine is just tearing itself apart.
Yeah, they have no idea.
Does the way the death benefit is structured at the time of purchase affect this trajectory? Because I noticed the files delineate heavily between option A and option B death benefits in these IUL policies.
Oh, the structural design is a critical factor in how quickly a policy can spiral. So when you purchase an IUL, you generally choose between a level death benefit, known as option A, and an increasing death benefit, known as option B.
Okay.
Option A is straightforward. The total payout remains fixed. You buy a $500,000 policy, your beneficiaries receive exactly $500,000.
Yeah.
As your cash value grows, your net amount at risk steadily declines, which helps keep those internal costs manageable as you age.
But option B is pitched as a way to maximize the payout, right? Because under option B, the death benefit is the original face amount plus whatever cash value you've accumulated.
Right.
So if I have a $500,000 face amount and $200,000 in cash value, my family gets $700,000. That sounds incredibly appealing on a marketing brochure.
It does appeal to consumers who want to leave, the maximum possible legacy. However, the internal mechanics of option B require a much more aggressive funding strategy.
Why is that?
Because the total death benefit is constantly rising alongside your cash value, your net amount at risk never truly declines. It stays relatively flat.
Oh, I see the danger there. If the NER stays flat at $500,000 for 20 years, I'm not benefiting from that intersecting curve we talked about with whole life.
Exactly.
My age is going up, my mortality rate per thousand is going up, but the pool of money the insurer is applying it to isn't shrinking.
And so the cost compounds aggressively. Option B demands that your cash value earns enough interest not only to cover an exponentially rising cost of insurance, but also to continue growing the death benefit.
Right.
If the market underperforms, or if you underfund the policy even slightly, option B will trigger a lapse spiral much faster than option A. It's a high-wire act that requires constant monitoring.
To really cement these abstract actuarial concepts, I think we need to look at the financial stakes for actual people. The Green Files provide 3 detailed consumer case studies that perfectly illustrate how funding habits and policy structures dictate the reality of the net amount at risk. Let's start with the simplest scenario. Maria.
Okay, so Maria's 35 years old. She recently purchased a $750,000 20-year term policy. Her goal is just pure income replacement while her kids are young.
So her situation is perfectly transparent. Because there's no cash value mechanism, her net amount at risk is locked at $750,000.
Right.
The insurer calculates the mortality risk for a 35-year-old female over a 20-year horizon, bakes that into a level premium, and she pays it. The risk is static.
The simplicity is the benefit there. Maria knows exactly what she's paying for, and the insurer carries the entirety of the risk until the term expires. But let's look at a more complex success story. Robert.
Okay, Rob.
Robert is currently 50 years old. 20 years ago, at age 30, he purchased a $500,000 traditional whole life policy.
So Robert has been paying a rigid mandatory premium for 2 decades.
Yep.
The Gruen audit shows that today, at age 50, he's accumulated $190,000 in cash value. So let's do the NAR math. $500,000 death benefit minus $190,000 cash value. The insurer's net amount at risk on Robert today is only $310,000.
Exactly. The financial realities of Robert's policy have shifted dramatically in his favor. When he was 30, the insurer was charging him for nearly $500,000 of pure risk.
Right.
Today, his mortality rate is higher because he's 50, but the insurer is reapplying that rate to $310,000. Robert's level premium easily covers the internal costs, and a significant portion of his payment continues to drive his cash value higher, pushing the NAR even lower.
So he has effectively de-risked his own policy.
He has. It's a textbook example of how the math is supposed to work.
But then we get to Linda, and Linda's case study is, well, it's a masterclass in how a lack of understanding regarding net amount at risk can lead to absolute financial devastation.
It really is.
Linda is 62 years old. At age 45, she purchased a $400,000 indexed universal life policy.
And the critical detail in Linda's file is her funding strategy. When she bought the IUL, the agent likely showed her an illustration with maximum funding and minimum funding options. Wanting to keep her monthly expenses low, Linda opted to pay the absolute minimum premium required to keep the policy active.
Right.
And she did this consistently for 17 years.
So she treated a flexible IOL like a rigid whole life policy, but without the mandatory overfunding.
Yes.
And the results are grim. At age 62, despite 17 years of payments, Linda only has $42,000 in accumulated cash value.
So when we run the formula for Linda, her $400,000 death benefit minus her $42,000 in cash value leaves a net amount at risk of $358,000.
Oh my God, that is catastrophically high for someone entering their 60s. The mortality rate curve is steepening. The insurer is applying that steep rate to nearly the entire face amount of the policy. Her $42,000 buffer is virtually nothing against those internal costs.
No, it's nothing.
Mm-hmm.
Linda's policy is deep into a lapse spiral. The green audit reveals that her monthly cost of insurance deductions now far exceed the interest her cash value is earning, and they exceed the minimum premium she's actually paying.
Wow.
Yeah, the policy is actively consuming the $42,000 just to stay afloat. She's on the verge of receiving a notice that her premium must triple just to prevent the policy from collapsing entirely.
Looking at this, I have to ask, could Linda's situation have been prevented if she had understood the math from day one? Like if she had known she needed to actively manage her net amount at risk?
The math strongly suggests that early intervention changes everything. If Linda had maximized her premium payments from age 45 to 55, she would have rapidly built a substantial cash value buffer while her mortality rates were still low. If she had, say, $150,000 in cash value today instead of $42,000, her NAR would be a fraction of what it is, and her internal costs would be easily sustained by the interest the policy generates. She fell into the trap of buying flexibility without understanding the responsibility that comes with it.
Which makes the green toolkit provided in these files absolutely vital. Linda didn't know her policy was failing until the internal engine had already caught fire. So how does a listener listening right now avoid Linda's fate? What are the actual red flags that indicate a policy is sliding into a lapse spiral?
Well, the warning signs are usually evident years before the policy actually fails, provided you know what to look for. The most obvious indicator is a letter from your insurer stating that your universal or IUL premium needs to increase to maintain the current death benefit.
I imagine human nature is to just ignore those letters or assume it's a standard rate hike like cable television, but in life insurance it means your NAR has spiked.
Exactly. It's a mathematical distress signal. Another major red flag is reviewing your annual statement and noticing that your cash value is stagnant or actively declining despite you making consistent premium payments.
Right.
A healthy permanent policy should demonstrate steady cash value growth. If it's flatlining, your cost of insurance is devouring every dollar you contribute.
The toolkit also highlights some behavioral red flags. For instance, if you bought a flexible policy a decade ago, funded it at the minimum level, and never requested an updated performance review, you're flying blind.
Completely blind.
Or if you're approaching your 60s and 70s, the exact decades when those mortality curves accelerate and you haven't audited your net amount at risk.
Yet the acceleration of those curves in your 60s cannot be overstated. If you don't have a handle on your NAR before you reach that demographic, the cost to rescue the policy often exceeds the value of the death benefit itself.
So let's make this actionable. If I am sitting across from my life insurance agent tomorrow and I want to audit my policy's health, what exactly should I be demanding to see? Because clearly, just looking at the death benefit and the current cash value isn't enough.
Not at all. The Gruen files provide 5 specific questions every consumer must ask to force transparency. Question 1. What is my current net amount at risk? A competent agent should be able to identify this figure immediately.
And if they pivot to talking about market returns or the total death benefit?
Press them for the actual NAR. Don't let them change the subject.
Okay, question 2 from the toolkit. How does my NAR project to change over the next 20 years based on my current funding level?
And this projection is vital because it reveals your trajectory. You need to know if the math is steering you toward Robert's scenario, where the risk diminishes over time, Or Linda's scenario, where the risk remains dangerously high as you age.
That leads right into question 3. What is my current cost of insurance rate per $1,000 of NAR? This forces the agent to show you the actual internal fees being deducted rather than just the premium you're paying out of pocket.
Right. Question 4 is particularly important for anyone holding an indexed universal life policy. If I increase my premium contributions today, how much faster will my NAR decline?
Oh, that's smart.
It helps you understand the mechanical leverage of overfunding. You're essentially asking, how much capital do I need to inject to force the insurer's risk down to a safe level?
And the final question, which feels like the ultimate stress test. At what age does my net amount at risk trigger a lapse spiral under a conservative 0% interest assumption?
The 0% assumption is crucial. IULs are frequently sold using illustrations that project 6 or 7% annual returns. If the market performs perfectly, the cash value grows, then NAR drops, and the policy succeeds.
But you have to demand to see the worst case scenario.
Exactly. If the market goes flat and your cash value earns nothing, how quickly does the rising cost of insurance drain the policy?
That plays directly into the pro tip highlighted in the files regarding in-force illustrations. When you request a review, the agent generates an updated projection of your policy's future. The files stress that you must look at 3 columns on that illustration: the current ROSI projection, the guaranteed minimum projection, and a midpoint.
And the gap between the current projection and the guaranteed minimum reveals your true vulnerability. If your policy only survives to age 90 under the absolute best-case market assumptions, but lapses at age 75 under the guaranteed assumptions, your net amount at risk is far too high for your current funding level. You're carrying massive market risk inside a product designed for life protection.
Wow, we have dissected some intense actuarial machinery today. To synthesize everything we've covered from the grueling technical files, let's lock in the critical takeaways. First, the net amount at risk your death benefit minus your cash value is the only number the insurance company truly cares about because it represents their actual financial exposure.
Yep.
Second, that NAR directly dictates your internal cost of insurance.
Oh.
A higher NAR means higher monthly deductions extracted from your policy.
Third, building cash value is not just about having a side savings account. It's a defensive mechanism. Robust cash value forces the net amount at risk down, which insulates your policy against the exponentially rising mortality costs of old age.
Fourth, flexible policies like IULs demand active management. Minimum funding leads to stagnant cash value, which keeps the NAR high and inevitably triggers a lapse spiral where the policy consumes itself.
And finally, you cannot treat permanent life insurance like a set-it-and-forget-it asset. You must demand an in-force illustration annually to track your NAR trajectory and stress test your policy against conservative market assumptions. The overarching lesson from these files is that permanent life insurance is a dynamic, living financial tool. The risk is constantly flowing between the insurer and the policyholder. If you choose not to manage that flow, the mathematics of the contract will eventually manage it for you, often with disastrous results.
It's a sobering reality check on how these financial instruments actually function. But as we step back and look at the entire ecosystem of permanent life insurance, analyzing how we are forced to overfund these policies just to drive the net amount at risk down to zero, it leaves me with one final structural thought.
What's that?
If the ultimate goal of building massive cash value is to entirely eliminate the insurance company's financial exposure by the time we reach old age, there comes a tipping point where they are carrying virtually no risk at all.
Yeah, that's very true.
Right. It makes you wonder, once your cash value nearly equals your death benefit, at what point are you no longer actually paying for life insurance and instead just paying a corporation hefty administrative fees to hold on to your own money? Something to critically analyze the next time you look at that locked steel vault, wondering who is really benefiting from the gears turning inside.